Look, it's been a really tough week for pensions this week with what's been going on in the stock market. And I just wanted to check in really just to update you with where Tracy and I are up to with our upcoming retirement and some thoughts about where we are with the stock market and how they're affecting pensions. Now, people who tend to watch this channel are in one of a few different positions. You're either building a pension and you're interested in hearing what I'm chatting about because you'll be in a similar position soon in terms of getting ready to retire. You're just about to retire, or you've already retired. So that's kind of the people who watch this channel. So we'll take that one by one. If you're kind of building your pension at the moment now, you could say there's a sale on at the moment, couldn't you? You could look at it that way and say that if you're looking to buy the main indices this week, then they haven't been this cheap for nearly 12 months now. So that could be one way to look at it. But that's a very glass half full way to look at it. Another way to look at it could be that everything you've saved and built up and invested over the last 12 months has had a pretty good shake up over the last few weeks, and the stock markets are not looking great, and you've actually lost some money. Thing with stocks and shares though, until you convert them stocks and shares into cash, then they are just bits of paper or just numbers in an app for you, aren't they? It's when you actually decide to convert that into cash. So that takes us to the second category of people really, which is those who just have retired or are about to retire. Now, if you were this week planning to go out and buy an annuity, it's been a disaster for you, because what that means is you're converting what you have right now in stocks and shares into an insurance policy that's going to pay out. If you'd have taken this out 3 months ago, you could have potentially had 20% potentially more in that pension than you have as of this afternoon. So that is a very difficult position to be in if you were looking at buying an annuity. If like many watching this channel, what you've got is a company pension, then there's a good chance that you get annual statements and you'll be blissfully unaware what's been going on with your pension over the last week. And if you do log on to the website of the pension provider that your company works with, you'll probably be in for a nasty shock today in terms of what's happened over the last 3 months. And if you look at these charts here, we can see that particularly the S&P has been an absolute disaster over the last 3 months there since Trump took over, and all the shenanigans that we've been having with the tariffs. So that has been an absolute disaster. But markets recover; they generally do recover. This feels slightly more unusual than some of the other things that have gone on in the stock market. So for me, it is a little bit more worrying longer term. Now where Tracy and I are, we're at that point where I'm literally just on the point of retirement. I'm fortunate in that I've got defined benefit pensions. Now they're unaffected by the stock market in the short term. Now the reason I say that they are affected by the stock market because my pensions were paying out a 60th every year. 60th of my final salary, and then the 2008 crash happened. Pension funds realised that they couldn't afford to pay me a 60th of the salary, so like many other pension funds, they now from that point on then only give you an 80th of your salary every year as a pension. So the stock markets do impact defined benefits, but not directly. So the way a defined benefit works is you put money in, there's a formula. That formula may change over the years, but it doesn't change very often. And we're in a fortunate position, Tracy and I, because we've both worked quite a lot in the public sector and have quite good defined benefit pensions, which aren't going to be disrupted. And because of that, even though I'm retiring now, 55, I wouldn't have been looking to withdraw from my defined contribution pots at this point until I'm 60, really. So, the stock market's got another 5 years to recover from what's going on this week for us. So we're quite fortunate there. Another thing it's definitely worth talking about is if you that's if you have a company pension. But what if you've got a self-invested personal pension, a SIP? Well, people use SIPs in different ways, and if you open a SIP and you put it in a default fund, that default fund will be balanced between bonds and between stocks and shares. And the bonds haven't done quite as badly over the last few months as the stocks and shares have. You might also have self-invested yourself, and you've made some decisions. And what many people have decided, and certainly what I did, is I put a significant proportion of my pension investments into a money market. Now that pretty much goes up 5% a year. It's unaffected by global politics and what's going on at the moment. It was 5% per year last month. It's 5% per year this month. Unless inflation changes dramatically, it'll stay at 5% for the next 12 months. Sorry, interest rates, not inflation. Part of my portfolio has been protected from this. The other part of the portfolio, I have quite a lot in UK shares, and they have been significantly affected, but not as much as if I'd invested in the likes of the Nasdaq and the S&P 500, which the American indexes. Anyone who's been watching this over the last 6 months or so, that I'm very down on the American stock market. I just think it's the price to earning ratios on the American larger stocks are just ridiculously high, and I could never have really committed to investing in the S&P or the Nasdaq. And I try to build my portfolio to dodge it really as much as I can. It's hard to dodge it when you look at world indices though, because the American stock market is so big compared to the others that any kind of impact in America will have a smaller impact around the world. My portfolios have taken a hit for my direct contributions, but I won't be drawn on them for 5 years. So personally, I'm not too worried. It's not going to stop me from retiring, which is the main thing. I'm locked into my retirement now. My notice has gone into my employer, and I'm just waiting to finish now. So we've been fortunate, but if you are in a position where you've heavily invested in likes of the S&P and the Nasdaq, and you do have a self-invested personal pension, I do feel for you this week. It's been really, really difficult. But markets go up and down. The thing is to not panic generally, isn't it? That's the general advice. And let's see where the markets head within the next 2-3 years, because that's the time frames we've been looking. Someone in the comments on the last video said they've got self-invested personal pension and they check it on the 31st of December every year. Now that is brilliant. That is fantastic. I wish I could do that, because you're not riding this roller coaster up and down every day, are you, on where the stock market's headed? And it's a much stressless way of investing for your pension. As pensions are long-term investments, so we shouldn't be really looking at our investments on a daily basis. We're not trading here, we're investing. We're not buying and selling every other day, hopefully, to try and time the market. That's not what pension investing is all about, is it? It's about, picking a long-term strategy and sticking with it and having lots of years to build them funds up gradually. And that's what we're all for. So I hope you haven't had too bad a week, and that your retirement plans have not been too disrupted. And Tracy and I's haven't been. So we are feeling fortunate at the moment. But good luck, everyone, and I'd love to hear your comments in the. I'd love to hear what you've got to say in the comments. Have a great weekend. Cheers.